Okay, well, guys, let me get through the rules of engagement and how this will rock today. So basically, today's session is all about your overheads. Is it evil or is it not? Which we're going to find out today. But the rules of engagement is super simple. Okay, so any questions you have, please type it into the chat box, and we'll aim to get them answered as we go through, either throughout the session or at the end. So any questions you have, you've just tested the chat box to see if it works. Make sure you put it into the chat box. Okay. Now, we are super fortunate to have two absolute world-class guests today joining us. We've got both Phil and Dan from Xact Accounting, who are going to ensure that each and every one of you here will walk away with an overhead forecasting model that Xact Accounting built, so you can understand your required revenue to continue hitting your net profit targets, especially when adding additional overhead staff, etc. You're going to know the importance of allocations, budgeting processes, as well as other financial tools and insights from a builder's accountant perspective. So Dan and Phil, I'll hand it over to you guys and kick off the killer session we've got today. But it's good insight to see where everyone is right now at this point in time.
Yeah, fantastic. Look, thanks very much, guys, for having me on deck today. So today's session is going to be around overhead. Is it good or evil? And I sort of call it the overhead bloat. So if you let overheads get away, success can breed an awful lot of overhead into your business. We want to make sure that we do have that under the microscope, and we are keeping an eye on it overall. So please jump in, drop in questions, but I'll probably start with telling you a little bit about us over at Xact Accounting, what we do, what we get up to, and I guess how I sort of fit into this puzzle. So we are Xact Accounting, and we are building and construction specialists. So all we chase are builders and anyone in that built environment. So if you swing a hammer on a nail gun, anything like that at all, we want to know about you, what you're up to, and I guess, essentially how your landscape's looking. And we also like to pick up people like architects, legal construction lawyers. I've got a couple of large turf farms on my books as well. So anyone that helps contribute to building a building, no matter where you sort of come from, I guess, around the globe, we want to know about you. So just like any good public practice accounting firm, we have, I guess, three main service lines. The first and foremost, if you sort of think about the ebb and flow of data in your business, is bookkeeping. So this is less so on the traditional side. We do the accounts payable, accounts receivable, bank recs, all that sort of side, but we go really deep with system integration. We do the job costing side with Build Xact, Build a Trend, Procore, a few other bits and pieces in the background. And yeah, that division is growing very fast. So we are specialists in that area. The next side is my division. So I look after a division called CFO Advisory. And then obviously we do the tax compliance side as well, which is tax structuring, licensing. Just a little bit about me and my world, just really quickly to polarize what I get up to. So if you guys talk to me about tax or GST or VAT or wherever you sort of come from there, I will poke my eyes out just because I just could not care about it. So your typical tax account will look in the rear vision mirror, tell you what your BAS and super and GST and VAT and all that sort of stuff is. Whereas a CFO advisory is what you call a commercial account. So almost the exact opposite of our tax colleagues. And they do some pretty amazing stuff that I can't do. But my world is all around budgets, margins, forecasts, protecting your profit, job by job profitability, scale growth, and the like. So I thought I'd tell you a little bit about me first. So, and just obviously CFO stands for Chief Financial Officer, in case you're wondering what that acronym stands for. So a little bit about us, who we're chasing, who we're after, who we like to sort of bring into the firm. We chase clients that are in a scale-up mode. So they're looking to scale up. They want to go from owning one or two jobs, and they want to add in 3, 4, 5, however many it is, and they want to go from owning a job to owning a business. And that's where we take it and give you guys a bit of a hand. We like growth mindset as well. So if you're looking to grow and earn some money, I mean, depending where you come from around the globe, conditions are still fairly good in the B&C space, especially in that sort of spec home, architecture design, higher end space. I mean, particularly here in Queensland, New South Wales, Vic is still booming. And what also happens with us as well is that if you're sort of going through that business journey, you sort of start off, you're really small, you go to your typical tax accountant, but it comes to a point when you reach a certain size and scale and sophistication that you probably need to trade up that person and chase a specialist in that field. So you don't have to use us. There's other building construction accountants out there, but if you're not using a specialist in your field, and if you are serious about scaling your business, highly recommend. Jump on Google, wherever it is, and check it out. The other thing that we do in CFO Advisory too is that we are a commercial running mate. So when you're up at 7 o'clock at night and you might have the better half sitting next to you and you can't sort of share the aches and pains with them, commonly in a large business, that'd be the CEO sweating it out, or the CEO will then call the CFO. late at night and go, hey, I've got these aches and pains. What do I do? I'm worried about making payroll in 2 days' time. I have no cash. What's going on? That's what we do. So a bit about us. I just wanted to lens this session a little bit, and please jump in with any questions as we go. Otherwise, I'll charge on. It's really, really, really important to understand how a dollar travels through your business. So whether it's $1, $1 million, $10 million, however it is, we need to understand how that dollar travels through. So in this instance here, I have a bar over to the left-hand side, and I've just chosen $1 million builder, for example. And then this is how a dollar transfers through your business. So the guys over at TPB obviously do an amazing job with sort of drilling in margin and protecting it and micro measurement and knowing your overheads. This here just gives a bit of a visual representation as the conversations I get up to with my clients on our side, and especially in the wider Xact community as well. So this is generalist in nature. Ideally, if you guys are running $1 million business, or say you have $1 coming in, cost of goods sold, direct costs, cost of sales, they're all the same names. Don't let people confuse you or accounts confuse you or me confuse you. Cost of goods sold, direct costs, all exactly the same thing. Should be running at around about 80%. So in layman's terms, 80% means that for every dollar you're generating, COGS should be taking an 80-cent bite. So that's to build the building. So cost of goods sold is really important. And I'll talk about the sort of differentiation between COGS and overhead shortly. But cost of goods should be sitting at around about sort of 80 odd cents on the dollar. So a dollar pops in, 80 cents gets chewed. Or if you have $1 million, 800K, or if you're running a $10 million business, $8 million should be taking a bite out of that. Now, you guys can do the sums. A dollar pops in, 80 cents comes out. Well, you're left with 20 cents, which should be your gross profit. Gross margin, gross profit, same thing, interchangeable. Overheads, and this is where we're going to spend a bit of time shortly, should be running at around about 10% or better. So again, this is a bit generalist. I mean, if you're a higher volume project home builder, you would expect that to be a bit smaller. It depends on the nature of the build, but you should be aiming for 10%, or if you're in that rock star territory, it should be in single digits. So basically, for every dollar you generate, you should be spending 10 cents or less on overheads, depending on how the business is structured. And then if you follow that sum through, so a dollar comes in, 80 cents comes out for COGS, left with 20 cents in gross profit. Overheads takes another 10-cent bite, and then guess what? You're left with 10 cents on the dollar at the bottom. This should be a pretty standard building and construction business overall. So I want to see each of you guys, if you're asking me, Dan, how much money should I be making? Well, you should be paying yourselves a pretty decent wage, and then you get a double hit as shareholders, but you should be making about 10 cents on the dollar at the bottom line. So that will edge your move. Feel free to jump in and drop in comments here as well. Happy to make this interactive, but I want to see you guys getting a 10% return on your business. This is what pain looks like. So if you aren't across your numbers, you're flying blind a little bit. I mean, I call this financial clarity. This isn't up to your bookkeeper, or it's not fancy buzzwords from the corporate, I guess the corporate world or anything like that. If you're not across these, this is commonly what I see, especially if builders don't have good reporting, good data, good tech, good systems, good processes in place. But hopefully everyone does under TPB's stewardship. But this is what pain looks like. So COGS blowout. You get overruns in, or you rush through an estimate, and now you're spending 90 cents on the dollar. You come on down to the bottom, you go, oh my God, there's stuff bleeding, cash flying everywhere. I don't know what's going on. So you add people, bolt that person on, bolt this person on. You think if you throw labor against it or get 5 or 10 bits of tech, whatever happens to be, your overhead starts to blow at the bottom. So again, this is just for demonstration purposes only, but you can do the sums pretty quickly. A dollar comes in, or $1 million, COGS are getting away from you or overrunning. It could be concrete, it could be whatever it is. That's 90 cents on the dollar. Overheads are blowing out to 15 cents on the dollar. And you can do the sums, well, very quickly, you're backwards. So this is what pain looks like. And now this is what great looks like. So depending on the space that you're in, I'd love to see COGS running at around about sort of 75%. So COGS is cost of goods sold. So hopefully you're making around about, I guess that's a 20 to 25% margin. And again, depends on the space that you're in. Overheads are in single digits. So you're running lean, you're running mean, efficiencies are working properly. You have really great technology in place to do the heavy lifting. You're not just sort of throwing people to manually data enter bookkeeping bits and pieces in there. Like there's heaps of tech out there that can give you a hand. Dex, for example, is a great nugget. So if you guys aren't using Dex in your business or HubDoc or one of those to automate your data entry processes, it's cheap as chips. Write it down, use it. It is excellent. And then coming on down to the bottom here, if you're getting a 25% margin and your business overheads are running at 8, well, guess what happens to your profit? It almost doubles. So questions that you guys need to ask yourself is that am I running a good profitable business? You know, if I approached Daniel Wilkinson and said, hey, Daniel, I want you to give me $500,000 for a 10% investment. I'm not saying that's what we do, but this is the questions you need to ask yourself. If you're running this business, absolutely not. If you're a building construction business getting sort of 15 to 17%, absolutely, because it's lean, mean, and it's spitting out a good return at the bottom. So today's focus is going to be on this little bar here. I'm not a huge fan of talking about it generally, because when you sort of look at where a dollar disappears, so cost of goods sold chews up 75 cents. I love that space. That's where you'll win and lose on the battlefield, but it's really easy for overheads to get away from you overall. So this is what this exercise is going to be about. So write it down. 10% or better is where overheads need to be. If you're running at sort of 8%, great. If you're running at 4 or 5% and your margins are up sort of around about 18, 19, 20%, you know, my view is spend more on overheads. You know, I'm not going to be one of those accountants that say cut costs, cut costs. It's all around how that dollar, $1 million, $10 million, how that dollar journeys through your business and where you're left with at the end. So a really, really, really important part around overheads is I like to quantify them as earners and burners. So an earner is someone that is on the tools, swinging the hammer. You might have a sub trade in. You might have some direct insurances, so like QBCC or HCBF or any of those, you know, stuff that you can directly attribute to a job, trades, materials, anything that sort of like builds the building, they are earners. So I just wanted to get really, really clear around that. And burners, so they are the support services that allow your earners to do the job and I guess keep the back office moving. So burners are people like me. I'm an overhead. I don't sit on a hammer and add value. It could be rent. It could be whatever it happens to be, a couple of cars for your admin people, computers, stuff like that. They are burners. So it's really important to get that differentiation right, you know, from the get-go. So your earners, so people that are on the tools, trades, and all the rest of it, they live above the gross margin line. So just the composition of a P&L, and I'll talk about that shortly. So you have revenue, cost of goods sold. One minus the other is gross profit or gross margin. There's another group, which are overheads. So they live below the gross margin line. So they're the support services that help you make money. And both absolutely impact the bottom line. So it's really important to keep both under the microscope and micro measure these as you go. So just to recap, if your P&L doesn't look something like this, so disregard probably the dollars at this stage, but if you haven't got your profit and loss statement sort of splitting out cost of goods sold, and I guess overheads over to the right-hand side here, and you probably need to do a little bit of work with your bookkeeper or TPB or whoever it happens to be and get this layout right. So you really want to draw a clear circle around trading income. Yeah, hopefully you got work in progress movements in there as well. As you can see here, really obviously, windows and doors, painting, they're all cost of goods sold. So you want to try and rip these out of the overheads. If you need a bit of help, I mean, obviously more than welcome to reach out. I love talking about this stuff, but you really need to try and get this composition right overall. So when you go one minus the other, you can see gross profit really clearly. And if you haven't got these percentages on your books, absolutely get them in. And I'll talk about the importance about these percentages a little bit later in the budget template I'll run through. So just quickly with any of these percentages, so if your accountant's talking about it or a friend, family member, other business owner, to calculate these percentages, it's all really easy. You just basically grab this gross profit line divided by sales. What's your overhead? Overhead divided by sales. So this is the ratio of the cents per dollar you're spending throughout your business. So for example, in this example here, and this is just some doctored numbers, for every dollar coming through, this business is making 23 cents on the dollar for every dollar that's coming in. And then with overheads, they're spending about 13 cents for every dollar that comes through. So when I get questions like, hey, Dan, you know, my overheads are running at 50 grand a month, or they're running at 20 grand a month, or they're running at $150,000 a month, I go, and I might get a follow-up question after that saying, well, is that too high? I'm like, well, I don't know. What is the ratio of overheads to sales? I mean, you could have a $5 million business and your overheads are running at 50. My advice is, look, you're probably doing monstrous nights. Your people are probably stressed. You have no tech, whatever it happens to be. My advice would be to spend. So we want to try and keep an eye on this and go, well, are overheads reasonable to the amount of turnover we have, the amount of activity we have in the business overall? And it's really important to separate these out. So one is earning your money, directly attributable. directly attributable. And the other side is overheads. So these are support services, me, bank fees, leave expenses, accounting, whatever it happens to be. Hopefully that all makes sense. So Vinny, hopefully we can fire up the next quiz and we'll see if everyone's been taking notes. The earners and burners.
Coming right up. There you go. Just popped up.
Thank you, mate. So the important one with this, guys, is when you're trying to work out whether overhead's good or evil. I mean, if you're carrying a business that has 30% overhead, it's probably evil. If you have a business that's carrying 5% overhead, well, I'd say, well, you probably need to start spending some money on overhead so the rest of the business can keep moving. So which of these individuals would be classed as earners? We probably made this a bit easy, so apologies for that one.
Yeah.
So that's on me.
It's delivering a good message at least.
Yeah, absolutely.
I think you'd be pretty brave to choose another option right now too, right?
Yeah, I was sort of interested to see if anyone would select estimators because it's a bit of a controversial sort of area because some people like to build in those costs, some people don't. Anyway, look, I mean, the answer's correct, guys. Well done, carpenters. Someone's chucked in a bookkeeper. They are a burner. They don't sit on a hammer or a nail gun or anything like that. Build Xact software, you know that allows you to do the job, but it doesn't create value as far as directly on site. Estimators are a bit of an interesting one, actually. Primarily, they're overheads because obviously they bash out quotes, do this and do that. Your win rate might be sort of 60, 70%, 50%. Just a quick sidebar, guys. If you have a 100% win rate on your quoting and estimates, you're too cheap. Lift it. I mean, your win rate, I mean, TPV, you guys are welcome to jump in and disagree with this, but if your win rate should be about sort of 50, 60%, 70% overall. If it's less than that, yeah, there's something going wrong in the background, but estimators are commonly overheads. So nice job, guys. Well done. So I think we are coming into the actual exercise itself very shortly. So how do you know if overhead is good or evil? So if we just follow this flow chart left to right, this will give you the answer overall. So adding overhead isn't necessarily bad. If you have business margins, so gross margins not markup, yes, there's a big difference. I know TBB hammered this into you guys, but it's super important. If you have a business that's running at a 20 or 22% overhead and you have, 20 or 22% margin and your overhead's at 5%, and you go, Dan, I'm not doing big hours, I'm feeling okay, my staff aren't sweating, you need to come and give me a course on how you're running your business. If you have overheads that are sort of sitting at 20% and you got a 23% margin business, I mean, the sum's pretty simple. You have 23 cents coming in a margin, 20 cents comes out of overhead, and then you only have 3 cents at the bottom. So you just have to know the timing around when you add that person in, when the payback is on that person, and then how much you need to scale to pay for that person. And I'll get to that very shortly. So like your diet, too much overhead can be bad, leading to overhead bloat. So how do you know if you're carrying too much overhead in your business? Well, step one, square one, is you build a budget. What are my revenues? What are my starts? When do they land? What margin am I generating out of it? Build out your overhead profiles in a budget. Drop them all in. When the dust settles, do you hit 10%? And I'll talk about good budgeting processes later. And we have got a separate webinar on this, so I won't go too deep on it. But a business budget isn't last year plus 10%. It's rock star level, has to have all the detail, the data, and then you measure yourself against it. It's no different if you're doing a drive from, say, here to Cairns or sort of, I guess, like a 3-day road trip in Canada or wherever you're having to go. You build a budget. This is where we're staying. This is how much we're spending. When you get to the end of the trip, if you've saved a bit of money, you might want to spend a bit more and lash out. Business is no different. Every single business and every one of my clients I've worked for or work with, they all have a budget because that's your business scorecard to go, well, how much money do I want to make? It's all personal. Some will be a couple 100,000, some will be a few million. It's all okay, but you have to have some clarity as to where you're going on that side. So you have a business budget. You go, well, if I want to add in another head, another person, particularly overhead. So we're not talking about carpenters or chippies or I don't know, blockies, anything like that. We're just talking about overheads now. So you can feel the pressure mounting. You have double the amount of work you did last financial year. You're starting to feel a bit of the pinch and you're going, okay, I need to free up and go do stuff on sales. I want to try and take a hat off and give it to someone else. It could be bringing on a full-time bookkeeper, estimator, wherever it happens to be. What is the impact of adding that person in? And that's the bit I'll get into right now. So Success can breed an awful lot of overhead, but that's okay. So I'll change gears now and I'll go to the Excel side, which is probably more my ground than the PowerPoint version. Can you guys see that okay? The Excel document I just brought up?
Yep, got it clear.
Yeah, excellent. So there's actually a separate calculator that we have got for this, which we will release to you guys afterwards. But what we want to try and understand is that there's a really, really basic concept of break even. So in this first example here, you might be starting to feel a bit of success. Your sales pipeline's working. Obviously, what TPB do upstream with sales and marketing and checklists and how to communicate with clients, which they do an amazing job at. You're starting to feel a bit of success. You go, oh, okay. You know, we're going from 3 or 4 starts a year to 8. And you go, oh, I'm starting to feel a bit of a pinch now. Yeah, maybe the wife or the better half doesn't want to do the bookkeeping anymore because it's turning into a full-time job, not a part-time job. You go, right, well, you know, my partner was very cheap, but now I need to pay a commercial rate for a bookkeeper. You know, so they go for 60, 70, $80,000, whoever it is, or you might need an admin person, unsure, or you might need a CA, depending on where you're up to in your journey of business, or you might go, hang on, you know, I do lots of high volume work, bucket loads of bathrooms, whatever it is, you might need a full-time estimator. What I want to know is that even though these numbers might seem small, so this is the salary cost plus super plus work cover, or any other sort of, I guess, employee insurance policies that you have in place. We want to know what the full cost of that person is going to be in your business. So that might include a vehicle as well. So make sure when you do this calculation that you do bolt on those additional items, phone, car, whatever it happens to be. And this is an annual cost. So for a full year, what does it cost to employ that person? Now, what's happening here is I go, well, if I add this person in for $80,000 a year, I know that's going to take an $80,000 bite out of my bottom line. You go, oh, that sucks. So what do I need to do? How much revenue do I need to get in? How much income revenue or how many starts do I need to get in just to pay for that person? So this is no additional income to you, nothing additional to your back pocket. How much harder do I have to work to cover this person? So hopefully you've gone through, I guess, the selection matrix and gone, yep, we're going to add a bookkeeper in. You have a position description. It makes commercial sense. They're not going to be sitting there twiddling their thumbs or they don't know what they're going to do. You find an expert, bolt them on. There's a calculation that you can do here that goes, well, depending on the strength of my margin. So just a reminder, a dollar pops in. And if you got a gross margin of 20% or 15%, wherever it is, that means you keep 20 cents on every dollar or 15 cents on every dollar to pay for overheads. And hopefully you as a shareholder get some money at the end. So this here is the overhead costs, 80,000, 80,000, 80,000. And I've just done a couple of scenarios with this bookkeeper. So the first section is going, well, if I have a really strong margin, it means your quality of earnings are excellent. So you can probably guess the revenue that you need to generate to pay for that person is not going to be too much more. So you only need to generate an additional $400,000 per year at a 20% margin to pay for that person. Now, if your margins are lower or you're in the project home space or you're in the sort of super high-end architecturally designed home space or you do monster builds at cost plus and the margin sort of diminishes, but hopefully you've got a bucket load of revenue coming through. So you basically sacrifice gross profit percent for gross profit dollars. And I can talk about this a little bit later. But if your margin diminishes, guess what happens to the revenue? Because you're not keeping as many cents per dollar to pay for that person. So $80,000 might sound like a small cost on a $3, $4, $5 million bill. But if your margin is diminishing or you don't even know what this is, how do you even know how much additional work you have to pick up to pay for that person, to cover that person? So this works the same way. So this could almost be like a break-even calculator for your business. So this will tell you that same number. How much revenue do you need to cover your business overall? So if you have nice strong margins, you know your numbers, the data's good, to pay for this 80,000 person is 400,000. If your margin is not very good, I mean, the revenue that you need to earn goes through the roof. Now, depending where you are on your journey as well, I have a couple of examples in here. You might need a specific admin person to help out. You might need a CA or contracts administrator. If I guess in that commercial world, similar sort of thing. I mean, as you build in bigger overheads into your business, you need bigger revenue to cover them. So when you bolt on an $80,000 person at a 15% margin, you need $500,000 in revenue to cover them. So $500,000 at 15% covers that. If you come on down to, I guess, a heavier salary, so say you're adding on an estimator for 155,000, and look, they are edging that way, especially the good ones, and your business runs at 15%, you need to generate an additional $1 million at that margin to pay for that person. So this is where we start to go, and again, the calculation is not that difficult, but this is where we start to break it down and go, oh, okay, this here starts to create the urgency and going, okay, I need to find another start. So say you're $1 million builder and you want to bring on an estimator or CA, you need to probably have another start to cover that wage of that margin. If your margin's strong, obviously it diminishes off, or if you're on that sort of larger project, smaller gross margin overall, you can see there's a huge gap between these two. So depending on the size of your business, this can have a considerable impact as to how hard you need to hustle to get these jobs on board. Hopefully that makes sense, everyone. And I'll start to talk about how we use this data versus a budget. But you can use this calculator for adding a car in. You can use this calculator for adding 5 overhead people in, whatever it happens to be. And this will tell you the additional revenue that you need just to cover this person or people overall, or it could be a vehicle, whatever it is. So it can be a bit of an eye-watering exercise, but you have to know what your margin is in your business as well. So I don't really care what you're quoting and estimating at. What I care about is what you're left with. So I speak to builders all the time. They're like, I make 20%, 22%. I pop the hood. I'm like, oh, yeah, what job by job profitability reporting you're doing? Oh, I don't really do it. I've got a bit of cash in the account. It looks good. Well, when the dust settles, I want to know how much of that 20% you keep. So you might start off at 20. You have a few hits and knocks. You might land at 15. So when you're trying to work out, well, how much additional revenue do I need to hire this person or hire this person or hire that person, it'll tell you how much revenue you need to sort of scale your business. And then the other thing out of this as well, and I'll talk about the budget in a second, is that, well, that's all well and good, but what am I going to do on the earners side to scale that up? Have my teams actually got starts? That, have they got spare capacity for additional starts? So I need to find another crew, whatever it happens to be. And then this is where you can start to get out, I guess, a bit of planning, build your acumen in this space, because numbers can tell a pretty powerful story. So your numbers aren't your tax account's responsibility as you guys as business owners. And there's 4 or 5 numbers you should know off the top of your head at all times. One is what's your turnover, what's your gross margin. You might have large jobs, small jobs. What is it on average? What's your overhead percent and what's your net profit percent? And what is your net profit in your business? You should know those numbers off the top of your head at all times, especially monthly, 100%. The philosophy behind this as well is that if you think about what a $50 million building business does, or think about a monster ASX listed business, where it happens to be, all we're trying to do is introduce that level of thinking into that SME space. So those guys and business owners and CEOs know all those. So that's what you guys need to do if I'm giving you some advice from one CFO to I guess other building construction business owners. So it's super important. You will get this tool at the end. I'll just flash this up. It looks exactly the same. You can enter the role. There's lots of helpful hints, and hopefully this will start to help you quantify and work out what's coming in next year. I'm good to charge on, Vinny, just before we jump into the next section. No big questions coming out.
Yeah, keep moving through. This is absolutely valuable and really fire. But just or a quick pause. If anyone does have any questions, feel free to keep putting them into the chat box, and we're either going to answer them directly. But otherwise, Dan, you're crushing it. I don't really want to stop you, so keep moving through, man.
All right. Thanks, mate. Thanks. Okay, so we're going to share a QR code at the end. We actually have a whole separate webinar on budgeting for builders. I wrap it on for, I think, an hour and a half or so, but really important. If you don't have a rock star level budget in your business, especially if you're in that sort of like 1 mil, 1.5 mil space or higher, or you're wanting to scale, I cannot recommend a budget enough in your toolkit. So it's not an accountant's tool or whatever it is. It needs to be your tool to go, well, what's our path and what's our navigation? How are we going? So what I want to do here is that this here is a existing client budget. I've doctored it a little bit, obviously de-identified it, but this is what a really good budget looks like. And this is a profit and loss budget. So it's not cash flow or anything like that. It's all around profit and loss. So what we have here is existing jobs. What is the income? And there's a whole heap of revenue and stuff that sits in the back end. These are the existing jobs. This is what they're called. This is how much we build out. Over here, July through to June over the right-hand side, this is where we're expecting all of our claims to come out. So hopefully you've got build schedules that sit behind this, so you can put a lot of science and evidence in behind the numbers. Otherwise, it's rubbish in and rubbish out. Down the bottom here are some new projects that we have on the boils, some aspiration projects in there as well. When do we think that they'll land? When is the time? And that's all built in. So the way the budget, the way the budget model works is that this will then pick up all the revenue and income over this side. And it's gone a bit funny here. So this will pick up your total trading income for each of your jobs. The cost of goods sold, cost of sales, whatever it happens to be, this will all self-calculate. So there's a bit of a formula in there, and this will give you a gross margin. So you can see here with peaks and troughs and all the rest of it, December's always quiet, but you'll always see that the margins are really steady. So the GP might go up and down, but this here is your magic number to make sure you're going okay, you're being efficient, you're being lean. Because even though your revenue might come down, if people are on leave, well, it'll be your balance sheet that pays for that, not the business. But that's probably another topic for another time. So this builder here is actually not doing too bad. They've planned out the year ahead, have their income, they know their margins. This is what we quoted. We know we can stick the landing, and we're trading at 23%. So gold star from my side. You come on down here a little bit further, and we have overheads. Now, if you go back to that original bar graph and we go, right, well, how is that dollar coming through your business? COGS have like an 80% bite out of that. So if I'm going, well, how do I move the needle in your business? I'd say that for every hour you spend thinking about overheads, you need to spend about 50 hours thinking about COGS and margin and defending it. And if we're overrunning, how do we claw it back? So I'm not trying to diminish the importance of overheads, but you're not going to move the needle by negotiating phone plans in your business. But if you're looking to scale up, and when do I bring on the right person, a budget can give you a lot of clarity behind that. So when you are building this out, I mean, I wouldn't recommend putting in, I don't know, licensing fees for build Xact at $59.84. A little bit rough is okay. I don't want you spending ages and ages and ages in this. So as you can see here in this builder's instance, they're running at around about an 11% number. So you come over here to the right-hand side, they're right on 10%. So funny that number lands right there. You know, it wasn't intended that way, but there are peaks and troughs all over the place. So there was an instance before where you go, hey, Dan, you know, if you're running into December or the Easter long weekend or stuff like that, overheads go up and down. That's fine. But I know for the year, we're chasing 10%. So when you start measuring yourself month to month, I don't sit in front of my clients, produce management packs and numbers and spread them all out and talk about it for 2 or 3 hours. I don't freak out when I see that because I know the future's okay. Usually there's a big rush to November, jamming our claims. You come to the other side of January, it might be a bit quiet. But I know in those, I guess the sprint, particularly between December and June, or even after April up till December, we know the business is going to be okay. So that's how you start to read and interpret this. So we know our scoreboard, we know what we're doing. Coming on a little bit further down, this is your net profit. So again, it bounces around all over the place. December gets a bit of damage as standard. I mean, I think most of my builders, probably 70 or 60% run in red territory here. But I know from April until December now, we're on the sprint, minimal public holidays, hopefully not much rain, and giddy up. And this builder makes 13%, which is excellent. That's the rock star territory. So that means for every dollar they're generating, they're getting 13 cents. And that is excellent for a builder. Anything above 12% at the bottom, after you pay yourselves a wage. So you guys are both in the business and shareholders, you need to be paying yourselves a decent wage. That's after that wage. So if you're drawing 120, 150, depending on the size of the business, that's probably what you guys need to start paying yourselves, maybe a little bit more if you're a bigger business. Plus that sort of 12, 13%, that's what you should be aiming to take home overall. So I haven't got another model that sort of talks about scale, but I'm going to start talking about this line here. So we've arrived at the business decision that goes, right, I need to add someone else into the business. I'm doing 70 hours a week, monstrous. I want to bring on a contract admin person. So when we come over here, I'm going to look at this contract admin person right there, and I'm going to go, well, let's just say we run at 20%. I want to bring someone in at $145,000 and I need to build in $725,000 worth of income. So I'm just going to keep this really basic. You can probably pick and choose when you want to bring them on board. It can be any time, any period, whatever it happens to be. I'm just going to go straight here. I'm going to add in $145,000 worth of costs and just roll it back to a monthly figure. So if we click and drag that one across, go across to there, come on down, you can see that's taken a pummeling, which is pretty obvious because all you're doing is adding this in, so that comes off the bottom. So if you were talking to me and you go, Dan, am I running a good business at 255,000? I go, I'd have no idea. What's your net profit percent? You know, what is your quality of earnings coming through? You say 8, I'm like, no, that's not very good. You need to pump it. But because you've done the hard work and you know your numbers and you know your margin, how your business operates, and you're not just adding overhead for the sake of adding overhead. You know what's going on. You have a position description for each of these guys or girls, whoever it is, and it makes commercial sense. You go, right, well, I need to build in a $725,000 job. Now, just to keep this really simple, here's one I prepared earlier. I'm just going to call a new person, whatever it is, because you're probably not going to know the next job. Because in here, these would be your known knowns, but we need to build in known unknowns. So what I mean by that is you haven't got it yet, but you need to sort of start hustling down and go find another start. So when we come back to this, a refresher, here's our $145,000 person. I've bolted them in as their own overhead line because you might want to change or adjust that wage, but you want to leave it separate out just so you can sort of micro measure how that's coming through. You come back in and go, well, I don't know where I'm going to find it. I've got 2-3 months to find another start. I'm just going to find it. I don't want 8%. I want 10 to 12%. So I'm going to come in here and go, well, this person, 725,000. And I'm going to come over the side here and go, well, I'm going to bill out one way or another $725,000. And again, some months you have no claims, some months you will. You might have a cost plus that does it every fortnight, whatever it is. I just want to see that income come in over 12 months. And we can talk about timing at the end if there's any questions. I'm just trying to do this for demonstration purposes. There's 60 grand. I've entered the margin in at 20%. So the market could be tightening up. I'm going to drop it a little bit. I'm going to come back to the budget and go, what's the impacts? Boom, we're back at 400,000. This is a good budget, a good forecasting tool, and this is how you analyze and I guess review your business's performance overall. So what you want to do is that if these numbers don't work, or say, Dan, hey, I'm only going to get this in half two, or, you know, hey, there's absolutely no chance I can get a start here, but I need the admin person to start earlier, that's fine. What I would do is I'd probably try and normalize these numbers and go, well, how much additional revenue do I need for a year to pay for that person for a year? And then if your timing's a bit disjointed, that's fine. It's okay that this has a bit of a hit, but you know when the dust settles and they're firing properly and your business is firing properly, you know the numbers make sense. So even though this is a plan and you go, well, Dan, how do I ensure I get this? Well, you need to measure yourself against it. So if you and me or you and TPB, and I know those guys will be keeping you accountable like a good accountability partner does, we'll be sitting down and going, hey, you're supposed to make 40 grand this month or an 11% return. You only hit 20. What the hell happened? And that's where you go deep. So if all your jobs are on budget, I couldn't care. If you're due to make 20 grand out of 123 Fake Street, you came to 21, couldn't care. Well done. Next. I want to know which one's bleeding, which one's missing, what's going on, where are we deviating from this plan? And then more importantly, if we are behind budget, I don't just want to take a knee. How are we going to claw that back? What are we going to do? How can we squeeze? How can we gamify some of this stuff? Do we need another start? We've got our timing variances out. So you might build a budget and one of the bills might be pushing out by 3 months. In which case you're generating less profit in this and that diminishes. That's how you use this tool and go, when you're trying to sit with your better half or your family or just you, how much money do I want to make out of this? We don't just take a knee and go, oh, that's moved, we're just going to cop it. Because your overheads don't go anywhere. If that start gets pushed out, you're generating less gross profit dollars, your overheads are stuck. 9 times out of 10, there's not much you can do. But what are you going to do to hustle down? Can you delay something, bring something in? Can you do a spot project, whatever it is? But how do we make sure we make at least 10% plus in this business? So that's probably all the heavy lift items from my side around this. This is how you use a good budget. There is a budgeting tool that looks exactly the same as this. So this is all free, obviously. I can't stress enough, especially once you guys start getting a fair bit of success. You go from 2 jobs and then like another 3 or 4 jobs landing, you're playing, oh my God, what I prioritize. You want to gobble them all up. And you realize pretty quickly it's just yourself and a part-time admin person. You probably need to find another full-time one. or a CA or something, just be really conscious of, and I see it all the time, builders get really desensitized to overheads because they've got millions and millions coming through the bank account. So if you think about gross income in a business, they go, oh yeah, I'll add 50,000 here, and I'll get another 70,000 admin person there, and I'll spend 20 grand for this bit of software. Those overheads, especially when you work out the relationship between the overhead cost and the margin, it can be eye-watering as to how much additional income you need to cover that person. So I'm not saying don't hire them, especially if you want to scale and grow. I mean, this is a scale growth mindset piece here. If you're happy doing 2 or 3 starts a year and that's it, or you might want to do one monster one that goes to 3 years, whatever it is. If you're in a retain and defend, this piece is probably not for you, but I'd highly recommend making sure that you guys make some money at the bottom. So making money isn't a dirty word or thought process, whatever it happens to be. This needs to be 10% plus overall, and I can't stress that importance. And this is how you use a rockstar level budget. Do your signs, have your plan, work out what you need to do. You might just add this person in and have no starts on the go. And then you go, Jesus, I need to talk to the guy, the TPB or my CFO, whoever it is, and go, how do I scale up? Because my current careers are at capacity. How do I find that? How do I do it? That's the scale growth mindset from this. And this is the fine line between is overhead good or bad or evil, or have I got overhead bloat? If that overhead numbers is greater than 10% or if you're 12% plus, I'm very worried. But if it's sub 10%, ideally 8%, you're running a really lean business. So well done. So just coming back out of this, and I'm sort of coming to the wrap stage and the questions time. We have a landing page here. Scan this. It has the tools. It has a heap of other bits and pieces on our website. Pull out your phones, give it a scan. I think this recording will come out separately as well, Vinny, from memory. Get amongst it. You guys are business owners. You're not just an employee. I mean, you have to know your numbers, your metrics, the impacts. Market forces will sort of push you around a little bit, but those that don't have a plan or a budget, or if you're adding on people, what is the plan with those people? You'll get left behind. And because builders' margins are so small, not in a negative way. I mean, you can get some pretty serious scale. You can add $1 million to your business pretty quickly, but you're not a legal firm at a 65% margin. I mean, builders travel around about that 20% mark. Just be really conscious of the steps and actions you take. But if you have a budget and plan, you measure yourself against it, you'll be okay. Touch wood, market forces, but you'll be ahead of the curve well and truly. And that's a wrap from me, I think.
Love it. Dan, hugely valuable stuff. Guys, I just want everyone just to pop in the chat box real quick. What's been that number one blinding flash of the obvious or an aha moment that you're like, wow, that is a big takeaway of mine? Or just simply your biggest takeaway that you're taking from today's session? Can you just put that in the chat box? Could be an aha moment, a BFO, or something of big value to you.
Yeah, and thanks everyone for coming along to this. Hopefully you got a bit out of it.
Yen's cost of an overhead employee. Overhead's way too high. Percentages, top stuff, Dan, much appreciated. Thank you, Mark, for your kind words. The real cost of having another overhead person to the company, yeah. I was sure that there are actually construction specific accountants out there. Yeah, you're in the right place.
100%. I mean, obviously, bias aside, I mean, I'd love it if you use us, but if you're at a certain size and scale and sophistication, you can't go to your all-rounder anymore. And this is my CFO coaching hat on for you guys. You have to find a specialist. Just like TPB, they are specialist building construction coaches. You don't go to a generalist coach. Accounting is no different. Bookkeeping is no different. Tax accounting is no different. I highly recommend finding a specialist. So
some big takeaways here.
Sorry, Vinny. There was a question earlier on around trying to break out wages into overhead and COGS, and particularly like owners' wages, because that can be a bit tricky if you're sort of still swinging the hammer here and there, or you're site supervising, those kind of roles. What's your take on that?
Yeah, so depending where you are in your business journey, I mean, if you're a bit smaller, you're probably still on the tools, which I'd recommend. I mean, if you're sort of turning over 2 million and you're sitting in an office, I'd probably caution against that. But you really need to sort of break down your day and go, well, how much am I on the tools doing site supervision, traveling around versus how much am I wheeling and dealing, like hunting the next sale, finding talent, stuff, all the rest of it. So if you have like an 80-20 split, so 80% of the time on site, motivating the team, visual leadership, all that sort of side, well, 80% of your wage should go to COGS and 20% of your hunting, gathering, sales, talent, all that sort of stuff goes to overhead. So if you're a bit larger and you're off the tools now and you're lucky enough to do that, well, guess where you sit? What are the activities you're doing? Well, I'm hunting, gathering, sales, wheeling, dealing. I'm on SIG. I'm doing claims for clients. Well, that's overhead. Yeah, they are burners, or you will be a burner, which is perfectly fine. So you need to shove your wage down the bottom and make sure it's 10% or less.
And that you can do that in that budget tool that Dan's put together that you guys got access to now. You can also hardwire that into your accounting system so that if you're using a good timesheeting platform, those kinds of things, then you can actually be separating out each of those timesheets to direct costs or to overhead costs. And so your accounting platform can just suck up all that data and you can print reports off the back of it.
Over
to you though with the rest of those, or Dan, if you wanted to jump in. Sorry.
Well, it's just sort of running top to bottom. So Alex, do COGS include employee costs? So Carla, great response. Absolutely. So a danger I see a lot of builders run into is, they just pay them a wage or a salary and go, yep, that's the cost. Well, rubbish. You need to consider, I call it the OOP, which is the out-of-pocket expense. So it's the wage, it's the super, you add someone on, you got additional work cover expenses, you got additional annual leave, plus. Sometimes that could be an additional 15 to 17 to 23%, depending on how you sort of stack that up. So it needs to be all inclusive. Don't get scared of the number. It's actually pretty easy to calculate. I can send you a calculator within sort of 10, 15 seconds, but it needs to be the inclusive costs because it's money that comes out of your pocket, 100%.
Dan, I want to make sure that our members don't walk away. I think it's super valuable understanding how much more revenue we need to secure in order to kind of pay or cover the cost of the new employee. But I don't want our members to walk away with this thinking of like, I can't possibly bring someone on, because the way I like to think about it is like, this person coming on frees me up to find that work, or this estimator helps me win more work. Could you just speak to that just a little bit?
Yeah. So
like a trailing shift of like expenses go up before revenue goes up.
Yeah, it's a really good point, Carl. And look, I sort of touched on it really quickly when I was sort of going throughout it. I was saying, well, when you bolt on your head, what's the plan? What are they doing? What do you how many hats are you taking up yourself to give to someone else so you can focus on other high leverage activities? Again, I'm trying not to sound arrogant here either, but I'll probably be one of the few accounts where if it makes sense, spend the money, spend it. I mean, if it makes sense, it makes commercial sense, and it frees you up to do other stuff, or you might want to get more time back with your family. I mean, as long as you guys are making a 10% return, spend the money. Don't freak out about paying the blocky or the bricklayer, during the month. I mean, if you're spending money, you're adding value, you're generating revenue, you're generating margin. The same principle applies to overhead. So if you hire a contracts admin and you get to get 20 hours off your plate, give it to them, and they'll find 20 hours of work elsewhere, what are you going to do with those 20 hours? Well, guess what? Revenue is going to have a hit. So you need to sort of bolster that sales hat a bit heavier and go, where am I going to find another start? How am I going to network? What architects am I going to speak to? Word of mouth, whatever it happens to be, find talent. You might find that you have no time to hire another carpenter. Well, guess what? You need to find time. So it's okay to spend the money is what I'm trying to say, but build a budget. You might have a hit because the timing might be out. You might have to sort of bring them on in February and your overheads take a hit. But guess what? Just build another 12-month budget and go, well, where do I get to that 10% again? It's perfectly okay to spend the money as long as it makes commercial sense.
Yeah, we talk about, it is impossible to scale without that overhead number and without those additional resources in the business. You'll hit a ceiling. You probably start seeing a therapist earlier than you'd like to. There's all those knock-on impacts to trying to continue to do everything yourself. And so, it's critical to unlock scale. You've got to have those additional resources come in, but you just need to be able to see, what the financial impact of that's going to be. And I think seeing that financial impact makes you more accountable for making sure that they've got clear job descriptions, they're well briefed around what they're going to be up to, and you very easily being able to see what value they're going to be adding to the business as well. Not just, look at all that money coming in, time to boost marketing or add an admin person. So, but yeah, it's. I was thinking the same, Carla. We don't want to sound like those accountants who are saying, "Don't spend the money." We're not like that at all. It's impossible to scale without having those additional resources and get some more of your life back as well.
Yeah, just another little caveat on that too. You know, the whole spend money thing. I mean, it's the whole spend money, and if you are spending money, you need to quantify the value that that person's adding. They don't necessarily have to be generating more gross profit, but the value could be time, or value could be quality, whatever it happens to be. As long as you can quantify that bottle alert and go, what am I gaining? What's the value that they're adding, et cetera, et cetera. It's perfectly okay to go down that path, as long as it makes sense. And again, you won't scale without spending money, but we want to make sure that the integrity of that dollar coming through your business is maintained.
Okay, we've got a couple of questions popping in. Mitch and Ash software recommendations. I believe this might be bookkeeping ones. I know you mentioned Dext throughout the session. Anything else that you would recommend?
Yeah, so I can't stress enough the importance of technology in your business, guys. It is so cheap, so accessible. AI is popping up everywhere. If you're still using, I know, debits and credits and the shoebox receipts, you're like you're an analog player in a digital world. So if you haven't got, us personally at Xact, we love Xero, love it. Plugs into everything. It's simple, easy, drill down. Bookkeeping software we love and recommend is a program called Dext. DEXT. We aren't affiliated with them. We aren't on commissions or anything like that. Love it. You basically send an invoice in. There's an automatic reader that works out the amount, the supplier, and the trade. So there's no keystroke. Shoves it back into Xero. Love it. As far as builder software goes, that is probably a little bit more personal, but we love Build Xact. We have a very strong partnership with them, just full disclosure, but we wouldn't have hitched our wagon to them. We're a building construction specialist firm. Builder Trend's not too bad. If you're a bit bigger, Procore's pretty good as well. But it's horses for courses with that sort of side. But you need a good technology stack. So off the shelf is Xero, Dext, probably Build Xact would be our choices. But it depends on you.
I've stumbled upon e-invoice on Xero, where you can cut Dext and HubDoc out, and go into the top right-hand corner, get your Xero email, and all you do is forward your invoices straight into it, and it does it for you, and it just cuts the process out. Because HubDoc I found super time consuming, and then my bookkeeper put me onto this process, and I've saved heaps of time just by going straight into Xero and cutting one process out.
Yeah, we like.
Well, there you go.
In terms of the interface and the AI that's built into it to be able to predict how it needs to be coded. So it does save some of that.
Xero do the same thing.
Yeah.
Because doing it that way, Xero does exactly this. As long as Xero knows, it can read the signature at the letterhead at the top, it'll do just about everything straight away. And I was using HubDoc, and for some invoices, it was just painfully slow.
Yeah.
But once I went into Xero, it was just snap. I saved so much time doing that just by emailing directly into Xero. And it's stored in Xero too for if you have any audits.
We might we might have our head of BK follow you up on that, Craig.
It's in the top right.
Dan and I are not the bookkeeping experts.
Yeah, but no, when you go into Xero and you got bills, in the top right-hand corner it says e-invoice. Click on that, it'll copy a link, and that's your email address to send into your personal email account, into your personal Xero.
I'll have a chat to Nadia about that. She's probably all over it.
She's probably all
over it. So I've got another question from Jens. Does Xact work with clients in the US? If not, do you have any recommendations you have?
Yeah, look, complex answer. I mean, the tax compliance side will probably be a little bit more challenging. I mean, but that's not my wheelhouse yet. There's specific local jurisdictions, etc. We don't work with anyone in the US currently. We have picked up a couple of people in NZ. I mean, this CFO Advisory division has been young, but we are exploding. So our reach is getting pretty deep. I mean, but the philosophies around margins and discipline and budgets, that's universal. It doesn't matter whether you're in building construction or tech or you're an arborist or whatever it happens to be. So short answer is yes.
Yeah, on the
I mean-
on the CFO advisory side, yeah, but I think the tax piece, you know, we're not about to dive into US tax, so
Yeah, I'm the wrong guy for that. Don't ask me about it.
Yeah. Understandable. Cool. Any other questions, guys? Please pop them in the chat box and we'll get them answered. Otherwise, I've just put the link for all the resources today. So basically the overhead forecasting tool, the budgeting forecasting tool, and a few other things in terms of past workshops, work in progress reports, everything that Xact Accounting has done. It's all in that link. Make sure you get access to that. But otherwise, I don't see any other questions popping through. So Dan, killer session today. My brain's exploded with value and I'm imagining everyone else here feels the same way. So guys, give Dan a round of applause.
Thank you, guys.
You can't really hear the claps, but you can see it.
Just so we can get the soundbite on camera here, could you say the thing that you said earlier where you said 1 hour spent trying to reduce your overheads should be 50 hours? Can you just repeat that for our people here one more time?
Oh, yeah, sure. So if you are in business and you're putting overheads under the microscope, for every hour you're thinking about overheads, you need to think 50 hours plus around COGS.
Perfect. Print it.
Thank you. Thank you.
Nice.
Thank you.
Okay, awesome, guys. But otherwise, have a great day, guys, and we'll see you all soon.